Oil has never just been about energy. More than fuel, it is a secret weapon, a bargaining chip, and sometimes the spark that ignites conflict. With a single barrel, nations can rise or fall. Alliances can shift and the fate of millions can hang in the balance. Every twist in a pipeline and every ripple in oil prices reverberates across continents, making petroleum the lifeblood of modern geopolitics. Oil almost always remains in the headlines. Namaskar and welcome to Sansad TV. I'm Rajiv Kumar Singh. In this episode of History Behind Headlines, we examine black gold, how oil reshaped power, politics and prosperity, and what its future means for countries like India. The commercial story of oil begins in the mid-19th century with the first commercial wells in Pennsylvania and the great fields of Baku in today's Azerbaijan. Early uses were mainly for kerosene lighting. The real strategic turn came with the internal combustion engine when cars, trucks and aircraft multiplied in the early 20th century. Oil became indispensable to mobility, commerce and war. Internal combustion engines transform logistics, trade and military planning. Petrochemistry followed, turning hydrocarbon feedstocks into plastics, synthetic rubber, fertilizers, medicines and industrial chemicals. Oil therefore became both motive power and raw material for modern manufacturing and agriculture. Oil's strategic relevance emerged clearly in the world wars. In the First World War, Britain's switch from coal to oil-fueled fleets improved operational range and speed. Securing supplies from Persia became a priority. World War II underscored the point. Germany's drive toward Caucasus oil, Japan's Southeast Asian expansion for Dutch East Indies crude, and Allied strikes on Axis fuel infrastructure showed that fuel logistics could determine campaigns and outcomes.
Every major conflict since World War II, efficient oil logistics have underpinned the strategic maneuvering force projection and sustainability of long campaigns, as well as the modern militaries integrate fuel supply management into operational planning, and this recognizes that any breakdown can lead to any setback also. So effective oil logistics remain critical to military success, and thus it acts as both enabler and also a potential actor or catalyst in high-intensity warfare.
After 1945, the world's energy mix shifted decisively toward oil and gas. Newly independent states with hydrocarbons found resources that could remake national budgets and international influence. By the 1960s and 1970s, oil had become central to diplomatic bargaining, development planning and strategic competition. Petroleum created extraordinary wealth but also distinct vulnerabilities. Many producer states became rentier economies, heavily dependent on export rents, which can weaken public accountability and encourage corruption. The resource curse is a persistent risk. Fiscally fragile states face instability when prices tumble. Even in 2025, countries such as Nigeria and Venezuela show how price swings transmit into fiscal and social stress. At the same time, oil revenues finance militaries, social subsidies and sovereign investment that project influence abroad. Oil price shocks have reshaped macroeconomies repeatedly. The 1973-74 embargo quadrupled prices and triggered stagflation in advanced economies. Subsequent shocks, 1979, the 1990 Gulf crisis, the 2008 surge, the 2014 to 2016 slump, and the 2020 pandemic, show how price volatility produces inflation, recessions, and political strain. More recently, Russia's 2022 invasion of Ukraine shook energy markets again.
It severely impacts on employment also and industrial growth as well. Then currency and trade imbalance also is a result of this entire scenario. As in, we can see that oil importing nations see their trade deficits widen and currencies weaken. So while exporters benefit and they shift their global financial stability. So these characteristics ensure that oil prices shocks repeatedly and profoundly influence economic growth, inflation, political and social stability across the world.
Oil is not just a resource, it is a lever of power. Producers can weaponize it by cutting supply or offering discounts to shape alliances. Wealthy consumers wield sanctions to choke revenues. Iran, Venezuela, and post-2022 Russia show how sanctions can sting, but also how easily buyers find workarounds. Security of supply is also built through long-term contracts, equity stakes, refining access and control of routes. Pipelines, LNG terminals and choke points like the Strait of Hormuz, Suez or Malacca are as strategic as reserves themselves. The Organization of the Petroleum Exporting Countries, OPEC, has 12 member countries. OPEC countries are located in the Middle East, Africa and South America. In the Middle East, Iran, Iraq, Kuwait, Saudi Arabia, United Arab Emirates are members of the OPEC. In Africa, Algeria, Congo, Equatorial Guinea, Gabon, Libya, Nigeria are members of the OPEC. South American nation Venezuela too is a member of the OPEC. Several countries have joined or withdrawn from OPEC over the years. There is another grouping called the OPEC Plus, which is a coalition of the 12 members of the OPEC and 10 additional non-OPEC oil exporting countries. OPEC Plus was formed in 2016 to coordinate and unify petroleum policies to influence global oil prices. Non-OPEC members in OPEC Plus include Azerbaijan, Bahrain, Brunei, Kazakhstan, Malaysia, Mexico, Oman, Russia, South Sudan and Sudan. When OPEC was founded in 1960, it was meant to wrest control from Western oil majors. Its 1973 embargo showcased the cartel's clout. In today's era, OPEC Plus, which includes Russia, manages supply to keep markets steady. Between 2023 and 2025, it used coordinated cuts to prop up prices in sluggish times. But OPEC's power is not absolute. The US shale revolution, along with new fields in Brazil, Guyana, has made supply more flexible. No single producer group can today hold the world hostage forever. The USA is a major producer as well as a consumer of oil, but it is not part of any major oil cartel, primarily because its free market economic system and strict antitrust laws prohibit anti-competitive collaboration among private companies. Pricing oil in US dollars created the petrodollar dynamic. Persistent dollar demand, recycling of export receipts into dollar assets, and reinforcement of US financial primacy. China and Russia promote alternatives, but as in 2025, the dollar remains dominant in most oil settlement.
Most global oil is actually traded in dollars, and this reinforces the currency's reserve status. So this system persisted because Middle Eastern exporters, particularly Saudi Arabia, they maintained dollar-dominated settlements, and by investing continuously back into United States of America's financial markets. So the liquidity, stability, and global reach of dollar markets surpass alternatives, while geopolitical pressure and the scale of United States of America's defense or security guarantees further anchor the framework. So even as challengers like China and Russia push for alternatives, there are different international platforms also like BRICS that are trying to break this dollarized economy or dollarized system or dollar-dominated system across the world. The structural inertia and the depth of dollar-based finance keeps the petrodollar central to energy trade.
Competition for oil fields, pipelines and terminals fuels geopolitical rivalry. The Middle East, Central Asia, East Africa and Arctic are strategic theaters. Damaged pipelines, blocked choke points or disrupted shipping cause immediate price and supply shocks with political consequences. Decarbonization is rewriting oil's strategic calculus. Investment in EVs, hydrogen and renewables accelerates, particularly in China and Europe. Oil's role in EU power generation has fallen sharply. Yet, transport and petrochemicals keep crude central for years to come. The International Energy Agency, IEA, expects demand to be resilient through the late 2020s before plateauing. A gradual, politically uneven transition. The winners of the energy transition will be those who control critical minerals, batteries and clean tech manufacturing. China's scale in solar and battery manufacturing gives it structural advantage. Producers who diversify in renewables, hydrogen and industrial value chains reduce the risk of stranded assets. By 2025, OPEC members supplied roughly 30% of global oil. OPEC Plus influence a large share of seaborne exports through coordinated quotas. These policies shape investment, budgets and geopolitical posture. Russia remains a major producer and has pivoted large volumes to Asian buyers using discounts and alternative shipping financial arrangements to sustain flows despite Western measures. That eastward reroute reshaped trade patterns in 2024-25. The United States, driven by shale, averaged field production above 13 million barrels per day in 2024-25, moving from importer to major exporter. That status gives Washington both market influence and financial leverage. The Gulf, especially Saudi Arabia, UAE, Kuwait and Qatar, holds the largest concentrated reserves. Saudi output averaged close to 10.5 million barrels per day in 2025. Gulf sovereign funds in the trillions invest globally to smooth revenues and finance diversification programs like Vision 2030. The Russia-Ukraine war, which started in February 2022, produced the biggest energy realignment since the 1970s. Europe sharply cut pipeline imports and ramped LNG purchases, storage and demand management to avoid rationing. The IEA, that is, International Energy Agency, projected substantial LNG growth into 2025 to offset pipeline losses. Price cap schemes and sanctions reduced some Russian revenue, but enforcement gaps and willing buyers meant volumes were only partly constrained. Europe's immediate decoupling is hindered by infrastructure lock-in, long-term contracts, seasonal storage needs, and limited short-term LNG cargo availability. Others lacking regasification terminals or alternative pipeline links face steeper costs. India faces a strategic choice. Growing demand, refining strength, and import dependence defines its options. The situation has further complicated by the US decision to impose secondary tariffs of 25% for purchase of Russian oil, aimed at squeezing Moscow's revenues after the Ukraine war. For India, which has leveraged discounted Russian crude to cushion its energy bills and keep inflation under check, these tariffs raise a tough question. Should it recalibrate towards more expensive but politically safer supplies, or continue balancing cost efficiency with strategic autonomy? Indian oil demand rose to about 5.5 million barrels per day by 2025 from roughly 4.9 million barrels per day in 2021, and imports cover over 85% of India's needs. Refining capacity surpassed 250 million tons per year, positioning India as a major processor and exporter of refined products. To secure supply and margins, Indian refiners turned to discounted Russian crude, roughly 1.8 million barrels per day in early 2025, which helped margins and fuel security but drew diplomatic pressure. New Delhi maintains that purchases are legal and necessary for energy security. Meanwhile, as reported, India has proposed that the US allow purchases from sanctioned countries such as Iran and Venezuela if the Trump administration insists on cutting down imports of Russian crude. India has emphasized that simultaneously cutting off supply from Russia, Iran and Venezuela, all major oil producers, could lead to spike in global prices.
We don't send people out there saying go buy Russian oil. We send people out there saying go buy oil. Now, you buy the best oil you can in the market. The whole narrative that it's gone up 9 times. I mean, it's gone up 9 times from a very low base. And it was a very low base because at that time the markets were more open. You know, why if countries in Europe and the West and the United States are so concerned, why don't they allow Iranian oil to come into the market? Why don't they allow Venezuelan oil to come into the market? I mean, they've squeezed every other source of oil we have. And then say, okay guys, you must not go into the market and guess the best deal for your people. I don't think that's a very fair approach.
India's upstream stakes abroad are expanding but remain smaller than China's. Policy priorities include expanding strategic reserves, strengthening domestic exploration, and accelerating renewables and efficiency to reduce import exposure.
We have the potential of several Guyanas in the Andaman Ocean. Here there is reasonable expectation because we found it in all those in that basin and in so many, I've got 2.5 pages of those exact locations listed, that you will find it. But you will have to go there, cost, how much it is, all needs to be evaluated, but it's pointing to good news.
A pragmatic resilience program for India would combine diversification of suppliers and contract types, expanded strategic storage, rapid deployment of solar and wind power to meet the 500 gigawatt target by 2030, incentives for upstream exploration and investment, deeper refining to petrochemical integration, demand management via efficiency and public transport, and development of battery and critical minerals industries. Empowering national oil companies to acquire upstream assets abroad and using financial hedges can further reduce vulnerability. China has long pursued a strategy of securing oil through long-term contracts. equity stakes in overseas fields, and massive investments in pipelines and port infrastructure. This approach guarantees stable supply, buffers it against price volatility, and allows Beijing to exert influence across producer regions from the Middle East to Africa and Latin America. At the same time, China has built dominance in clean tech exports, batteries, solar panels, and EV components, positioning itself for the energy transition while still locking in fossil fuel security. India, by contrast, remains heavily dependent on spot purchases, often chasing discounts in a volatile market. Its refining sector is a global strength, but upstream investments, equity oil in overseas fields, strategic reserves, and long-term supply tie-ups lag behind China's scale. Over 2024-25, as China consolidated a large share of global clean tech manufacturing, India's challenge sharpened. It must scale domestic manufacturing capacity and aggressively pursue upstream oil investments abroad to close strategic gaps. Without parallel progress on both fronts, India risks being squeezed, paying more for crude while relying on imports of future energy technologies from its main rival.
India's compounding dependence and the limited upstream actually exposed it to the sanctions, as in the punitive tariffs imposed by United States of America at the moment. However, we can see that India has already prioritized its different global partnerships, ranging from different strategic agreements signed with the countries like Ghana in Africa, as well as countries like Chile, or for that matter Argentina, which are a part of lithium triangle region in Latin America. And India is also trying to diversify its reach to the other like-minded nations in terms of prioritizing its global partnerships in the area of energy. And it is also investing in green technologies and building strategic reserves.
Sanctions can choke a regime's revenue but require tight enforcement and multilateral backing. Venezuela's output collapsed under sanctions and governance failures. Iran remains limited in exports. Russia's volumes declined, but alternative buyers and shipping tricks mitigated some impacts. These cases show sanctions work best when globally coordinated. The 1973 Arab embargo did more than spike oil prices. It reshaped global finance. Petrodollar recycling increased dollar liquidity and linked oil revenues to Western capital markets. That arrangement helped finance development and deficits, but also tied producer fortunes to volatile commodity markets, prompting large sovereign investment portfolios and new geopolitical alignments. When prices collapsed in 2014, the combination of overinvestment and high-cost production exposed vulnerabilities. US shale, with rapid response cycles, later acted both as supply source and a market dampener, shaping investor expectations and national strategies about energy independence and resilience. Post-2022, sanctions prompted creative workarounds, ship-to-ship transfers, reflagging, and alternate insurers to keep barrels moving to buyers in Asia. These informal mechanisms, a shadow fleet of sorts, show how market arbitrage and geopolitics can coexist, complicating sanctions enforcement. Oil's centrality flows from its energy density, ubiquity in transport, and essential role in petrochemicals. Institutional structures from OPEC to the petrodollar and global shipping bind oil into geopolitics. The energy transition will be gradual and uneven. Nations that diversify, invest in clean tech, and secure supply chains will hold advantage. Others may face fiscal stress and geopolitical pressure. OPEC Plus coordinated cuts supported prices through 2023 to 2025. Russia redirected significant flows to Asia using discounts and alternative shipping. India consolidated its refining hub role, processing discounted Russian barrels. Europe accelerated LNG imports and storage to offset pipeline reductions. The US remained a major producer while scaling clean energy incentives. Watch demand concentration in Asia led by India. New supply openings in Africa and the Americas. The pace of clean energy rollouts and the frequency of geopolitical induced supply shocks. The interplay of these forces will determine how quickly oil's geopolitical primacy fades and which states seize new advantage. For policymakers, diversify supply, invest in decarbonization and critical minerals, protect vulnerable households during reform, and strengthen multilateral mechanisms to improve sanction enforcement and market stability. Strategic reserves, targeted industrial policy, and international finance for clean tech will shape who benefits from the coming transition. In sum, black gold remains central to economic, strategic, and environmental dynamics. Conflict-driven disruptions, cartel maneuvering, transition pressures, and the politics of supply underline why energy policy is a core part of statecraft. The choices nations make now on supply, technology, and sustainability will shape global power and prosperity for decades. That is all we have in this episode of History Behind Headlines. Thanks for watching on Sansad TV.
संसद टीवी के और भी प्रोग्राम्स देखने के लिए सब्सक्राइब करें हमारा YouTube चैनल और हाँ, इन्हें लाइक और शेयर करना ना भूलें।